Hi, in this small video, I'm going to explain about types of fund accounting. There are two types of fund accounting. So I'll explain, in next 5 minutes. So see this. So as I said, there are two types of accounting. One is net or cash accounting. So it means only transaction that you can record when you received it. For example, let's say dividend you have received, then only you can record it. Interest payment, once you received, then only you can record it. If I talk about, let's say, management fees paid or expenses which has been paid, right, those expenses you can consider as a net expenses. So it means here, if the transaction nature is net or paid or received, in that case only you can record it. Transaction nature is received and paid, so that accounting becomes your net accounting and cash accounting. And if I talk about if I classified that net or cash accounting, if you see, direct expenses and income come into picture, so which can be your discount you have received, or maybe let's say admin fees which has been paid, or different expenses or income that you have paid, that expenses which you can treat as a direct expenses which you have received and you have paid it out. Apart from this, you can see outstanding income which you have received. Outstanding income, it means someone or your counterparts paid interest payment in advance to us, so that becomes outstanding income. So it means here you can see the direct connection of cash component which you have received. Again, that you need to record it, and that comes under your cash basis accounting method. Another one is prepaid expenses. Prepaid expenses, it means the fund manager or let's say the counterpart paid expenses to the, let's say, vendors or XYZ institutions in advance for a next accounting period. But if you see here also, you can see the direct connection of cash, right? If you see, the cash is the direct component or element in the transaction, that accounting you can call it as a cash or net basis accounting. Apart from this, as I said, you would see another types, which is accrual type. Accrual, it means which the expenses or income which has been incurred but yet to pay or received. So that expenses or transaction you can call it as an accrual transaction, and that is also one of the another type which you can say, and which is one of the effective type to record the transactions in the complex business segment or line, like custodian business, fund accounting business, or any other broking business and all. So if you see accrued transaction type, you can call it as a non-cash adjustment as well. So here in this transaction, the cash which you can see, which is not a direct link with the transaction. For example, let's say dividend is due. Dividend is due, it means dividend is yet to receive. Company announced dividend, but that yet to receive to us. For example, let's say accrued interest payment. The interest payment which they accrued on investment but yet to receive. For example, let's say expenses. Let's say admin fees. Admin fees, fund manager, which is fund has incurred fees, but fund manager yet to make a payment of admin fees to the XYZ counterparts. So that becomes your accrued expenses or accrued income, or I would say non-cash adjustment, which you need to update in the books of account to inline the profit and loss account statement as well as balance sheet also, right? And if you ask me the reference, Indian Accounting Standard 115, which is a the revenue recognition or revenue recording principle, which defines the framework for accounting types, let's say accrual accounting procedure, I would say. And apart from that, IFRS, International Financial Reporting Standards 15, which defines revenue from the counterparty, how you can record it in the books of fund. That 15 defines the terms and everything. I hope now you got the idea about different types of accounting. There are two types of accounting, as I said. One is cash basis or net basis accounting, and another one is non-cash, so which you can say accrual basis accounting methods. All right. So here, if you can see Indian Accounting Standard 15, Indian Accounting Standard 115 revenue from contracts. If you see the process, which is, so here as per the standard procedure, how you can do it: identify the contract with customer, identify the performance obligation, identify or determine the transaction price of the contract, and allocate the transaction price to the performance obligation and recognize revenue from the entity or that particular transaction. So this is how you can maintain the data. So it means requirement is price, quantity, amount, and how much amount or that you're gonna receive from the counterparty. Then only you can record it. If the counterparty or any document, if that doesn't support or not provide any enough information, then you cannot record a transaction as accrued in the books of account. Because if you see this revenue from contract, so it means you should have a contract or deed in place or any document in place which can defines that you're going to receive. For example, dividend. When you receive dividend, you should have a holding. That's how you can claim for a dividend as an accrued dividend. What about interest payment? If you don't have a bond investment, then you cannot claim for a bond interest payment. So see, you would see the linking between each other. And now if I talk about IFRS 15, if you see IFRS and even Indian accounting standards, they both works in the same direction. Identify the contracts with customer. Same, if you see this one, identify the contracts with customer. Then identify the separate performance obligation in the contract. So it means there should be any documents which provide that information that you're going to receive interest payment or dividend with this percent or that percent, right? So there should be a backup, in short. And then determine the transaction price. Transaction price, it means let's say 100 rupees, 200 rupees, amount that you should know, how much amount that you're going to receive. Then only you can record it. Then allocate the transaction price to the separate, let's say performance obligation. So you can, allocate that to the separate obligation and then recognize as a revenue or expense. It can be revenue or it can be expense. So this is how you can link it, because this principle, it's a very essential or important, I would say, because without these two principles, you cannot do the fund accounting, you cannot do the investment accounting, you cannot do even normal accounting as well, because there's two accounting types which provide a lot of insight or framework for how you can record the transactions in the books of account. And without, as I said, without these two principles, you cannot go ahead with in your accounting. So I hope now you got the idea about how that accounting works. If you like this initiative, or if you like this content, don't forget to click on bell icon button so that you will receive notifications. And apart from that, if you're looking for a fund accounting, basics of accounting, accounting finance, or any finance related courses including capital market and all, you can quickly give me a call, or the number which we have already updated in the job description, video description. All right, so give a call and enroll for the courses and upskill your skills for better opportunities, I would say. So thank you for watching this. We'll see you in next video. Bye.